Welcome back. So we are going to understand. So we in the last session we understood about the global regulations related to climate change and how RBI and even in India the climate frameworks are evolving. You can also find that we also discussed in the last session about the taxonomy, climate taxonomy. So taxonomy is very important, that how and which all activities are important to understand. So climate stress testing goes by this. So climate stress testing evaluates the resilience of banks under climate related shocks, and why it is required, because climate risks are long term but financially material. So this is very important. If you go on the RBI website, there is something called financial stability report. This FSB report has the stress testing done on the banking sector, scheduled commercial banks. But this stress testing is done mostly on the credit side, loan side, and how much is the risk. So they include certain indicators, but they do not include the environmental factor. And this is where the central bank is emphasizing on the climate stress testing by the bank, so that they can see that whether due to PD increase linked to the climate events, how it is impacting. So transition policies may cause abrupt asset pricing and those. So climate scenarios, credit losses, and capital impact is this scenario that we are mentioning here. So let's understand with the physical stress scenario. For example, physical risk arises that we know, acute and chronic, right? So flood damaging industrial clusters, heat waves, cyclone. So exposure to coastal infrastructure is suppose 8,000 crore. If cyclone increases PD from 2 to 6%, right? So your change in expected loss is going to be how much? So if the LGD is 50%, so it is going to be 160 crore, which means that this is going to be one of the important indicators, right? So 160 crore that we are seeing, so 160 crore has to be absorbed by CET, that bank has to maintain this, otherwise it will create problem. So that's why we saw that the climate change is also helping in terms of Basel III norms. We had the capital buffers, right? So the banks, in case they do not have this CET1, then they can request the central bank to give the permission to use this buffer, and then they can simply pass on the risk easily, right? So this is what. Then transition risk stress scenario could be like a carbon tax introduction, coal phase out regulations, and the rapid renewable energy adoption. So it could be like loan exposure to thermal power is 12,000 crore. The probability default, because the climate related event, it went up from 5 to 9%. Now we are seeing that 9 minus 5, it is 0.04 into 0.5, it is 12,000 crore. So total it is 240 crore, right? So this is what. So transition shocks may also reduce collateral value. So here we have loss given default going up. So this is what it implies here, right? Now second, we look at the capital adequacy and the ratio sensitivity. So CET, we know that it is 12,000 crore. Risk weighted, we know that it is 1,50,000 crore. So now we know that ratio is going to be 13.3%. If the cumulative climate losses are 2,000 crore, so you can see that 2,000 crore will be eaten from this. So 20,000 minus 2,000. So bank is left with 18,000 crore. Now you can see that the common equity tier 1 ratio has come down further to 12% only. Now this is the risk that we see. So in stress testing, you have to make sure that this comes to this level, otherwise it will create trouble. Now there are internal capital adequacy assessment process. For example, in Basel II we had discussed already that internal capital is adequate to comprehensive risk profile, that we also dealt with the supervisory expectations. So ICAP is monitoring the climate related financial risk and how and whether they are material or not. So that dimension is being touched. So again, since we have covered most of the commercial banking related indicators, so it is easier to understand that climate risk channel within ICAP is high probability default and loss given default. Market risk regarding how much it is in the carbon intensive securities and standard assets. Operational risk due to extreme climate events, how much the business activities get impacted. Then here we have the concentration risk, right, how the sectoral level changes are impacting further. So all these things are linked with this dimension. The under ICAP scenario, they also try to touch upon that the how much they have to create a scenario for projected CET1 stress. So they calculate that how much the bank has the CET and how much it is getting deducted due to climate stress, climate losses, and this they calculate in terms of CAR stress. So the ICAP is also telling banks that you are reporting your CAR. Suppose RBI maintains that it should be 9% under Basel 1. Bank is saying that I am maintaining 12%. But after deducting the capital losses, if the CAR comes down to 8%, right, then this is a challenge for the bank. You are not meeting the regulatory requirement. So now there will be a CAR stress for the bank. Under that, they will have to calculate the CET1 stress and then how much you have the risk weighted asset under stress. So it is mainly to have the idea about how much they require the capital buffers. Then align the internal risk appetite and long horizon climate exposure, and inform supervisory review and the evaluation process. So SRAP is going by this. So this is where it is very, very important. Now climate stress testing of the Green Bank India. So total asset is 200,000 crore. The loan book is 1,20,000 crore. The exposure to thermal power is 10,000 crore, right? And then here we have the common equity tier 1 capital is 18,000. The RWA is 1,50,000 crore. So this is what. So your initial CET ratio based on these indicators, it is going to be 12%, right? So which means that you are able to meet. So for example, suppose you have the sudden carbon tax introduced, transition risk, coal demand declines sharply, the power tariff regulates downward, and as a result your PD increases, LGD also increases, and this will have further impact. Now you can see how much we are seeing. So here we are having the expected loss is coming out to be 0.02 and 0.5, so it is 100 crore. The expected loss under stress is coming out to be 0.06 and 0.50, and it is coming out to be 300 crore. So overall the incremental loss due to climate transition is 200 crore, and 200 crore bank will have to think about absorbing if they have a sufficient CET1, otherwise they will have to look for a capital buffer. So this is where it is very, very crucial to understand that how over a period of time the banking sector regulation is changing and they are incorporating new rules. Suppose initial CET1 is 18,000 crore, so this will be around 17,800. Now you can see that earlier the CET1 it was 12%, right, that we saw here, but after climate change we are able to see that it has come down to 11.87%, which means that due to climate shock, particularly climate shock, we are seeing that the CET ratio has changed and it has come down to 11.87, and this is where the moderate decline but repeated shocks across sectors can compound the impact and will further have the stressful scenario across, and this is where it is very, very important that we must understand the impact of the climate risk, right. So this is what is multi-sector amplification. Like suppose similar stress occurs in steel sector, which is coming out to be 8,000 crore, cement sector, which is coming out to be 5,000 crore. Total additional stress exposures are 23,000 crore. If average PD increase 4% and LGD 50%, then we can see that your delta EL is nothing but 260 crore. Your new CET1 is how much? It is 18,000 minus 260. So it is 17,540, and this is where it is very important to note. So climate risk becomes systemically relevant when it is sectorally concentrated, and this is where we see that due to climate related events how it is changing. Now if we are thinking about the dimension, so I hope when I am saying increase in PD, it means that bank is doing the analysis internally that we discussed through logistic regression, right? So they are calculating PD through logistic regression with the KYC data, and they are saying that they are including the climate events also in that regression, and with that they are saying increase in the PD, and this further creates the stress testing also helps you understand the requirement for the capital buffers. Then the sectoral concentration, which is one of the important indicators for showing the impact, and we can also see that how the climate shocks are eroding the common equity tier 1, and this is also linked with the how the certain the sectors or other the carbon intensive activities are linked. One important concept that I wanted to touch upon, so we have already covered this, we covered where in the systemic risk scenarios. If you refer to the lecture systemic risk indicators, where we have discussed where we have discussed where value at risk, we discussed co-where, then distance to default, distance to capital, S risk, right? All these indicators we have covered. So this is where, but now they are talking about climate where. So climate value at risk, the potential loss due to climate risk under scenario alpha. So unlike traditional where based on the historical volatile, the climate where is based on scenario based policy or the physical shock that we have, uses forward looking climate pathways and incorporates transition. So what is the idea? That with X% confidence, climate related losses will not exceed climate war over the chosen horizon. So this is what, so probability value at risk basically measures the expected loss that you have given the level of confidence. So which means that you can lose only that much amount, not more than that. This is what here it says. With X level of confidence, with X percentage level of confidence, climate related losses will not exceed climate war, and this is what we calculate in terms of value at risk, right? So for example, portfolio exposure is 5,000 crore. Assume carbon pricing shock causes suppose 15% value decline in correlated assets, 5% decline in heavy industry exposure. So the weighted loss is how much? So 15 plus 5, so it is 10%, right? So 15 plus 5 upon 2, you can say. So it or you can simply go for equally 0.5 multiplied by 0.15 plus 0.5 into 0.05, and then you can get. So climate wire is going to be how much? So 0.10 into 5,000, which means that 500 crore you have. So which means that under severe transition scenario, bank may lose 500 crore. So this is what is the meaning of climate wire. Climate wire. So here we are saying that if we are going for the transition related risk measurement in the climate wire, which may call it as transition climate wire. So here the portfolio exposure for the bank is 5,000 crore. They are going to see the carbon pricing shock. So this shock is basically, it is declining 15% in value in correlated assets, 5% decline in the heavy industry exposure. So it is about 5%. So weighted average climate loss impact is 10%, right? So climate wire is 0.10 into 5,000, so it is 500 crore. So this is what, under severe transition scenario, bank may lose 500 crore, and this is what it implies. So climate wire quantifies the standard asset risk, supports supports capital planning under climate stress, enables the sectoral risk concentration assessment, and so on, and this is what it implies here. So traditional wire is nothing but short term market volatility. Then climate wire is nothing but, here we have the long term structural transformation rate. So this is what it implies here. So the primary objective is it quantifies the potential loss under a climate scenario. Time horizon is medium to long term, 5 to 30 years, and methodology that we calculate. So it may not be possible in this particular session to cover everything, but I am just giving you the idea so that you can easily touch upon. So often medium to long term, 5 to 30 years, estimated loss, it has to be in terms of rupees or in percentage. So these are the comparisons that you can see easily. So climate war estimates how much could be lost, whereas climate stress testing evaluate how bank can survive. So this is difference between climate war and stress testing. In stress testing, we are considering all the indicators, but here we are just going by the loss estimation that we have. So this is where it is important. Now one more topic that I want to touch upon is the topic of green banking. In case of green banking, there are activities related to the financing renewable energy, so solar, wind, hydro, funding energy efficiency projects. So green banking basically refers to banking activities that promote environmentally sustainable economy, and it lends only for those purposes. So this is what it implies here. So for example, if you are looking for energy efficiency projects, for example, in India, Government of India launched the Perform, Achieve and Trade. So PAT scheme. So under that, if banks have borrowed, if firms have borrowed, it is called PAT, Perform, Achieve and Trade. Financing renewable energy, so it is solar, wind, hydro, funding energy efficiency projects, so it is all about this. Green buildings and sustainable infrastructure, so if you are going for that. Electric mobility and clean transportation, so it also includes that. And it basically talks about the lower long-term transition risk, policy support and regulatory incentives, and growing investors' demand for ESG and others. Those are related to this. In the Indian setup, I thought it will be good that if I introduce you to the BRSR framework, because BRSR requires understanding. So SEBI introduced this for top listed companies, right? There are three core structures. One is the general disclosure. They have to give about business profile, governance and all. We were board members, how many are, compositions and others. Second is management and process disclosures are important. So they have to declare about how they are producing and what is the overall management system. Then section C is about the principal wise performance disclosures, and this is where they focus on all the declaration that they have to do. And TCFD, GRI, it is called Global Reporting Initiative, GRI, and SDG, Sustainable Development Goals. All these things are linked with it. Key climate related disclosures under BRSR. So BRSR requires quantitative sustainability metrics. So environmental indicators are scope 1 and scope 2, greenhouse gas emissions. So second is energy consumption. Third is water usage and recycling, and fourth is waste generation disposal. For example, firm reports total emission 1 million ton of CO2, emission intensity 0.8. So these are all called related to the environmental indicators. And scope 1 and scope 2 are the critical indicators that they have to maintain and they have to also keep in mind. So this is where it is important. And why BRSR is important? Again, the transition and the fiscal risk matters. The credit linkage is that higher emissions lead to higher carbon cost, lower cash flows, and it also leads to higher PD that we often talk about, right? And suppose the loan exposure is 2000 crore, the carbon pricing reduces the EBITDA by 15%, PD rises by 3 to 5%. So here we can see that the overall cost will be for this particular bank of 20 crore, and this 20 crore basically gives you the idea that from where it is. So BRSR basically converts sustainability information into measurable financial risk, and this channel is important. Higher emissions, higher carbon cost, lower cash flows, and a higher probability of default that we are seeing it here, right? So this is where it is important. There are other related regulations. One is the Basel Committee principles on climate related financial risks. So here it is about the how many. So BCBS, which is the Basel Committee on the banking supervision, I think in the last session also we had the BCBS. So it basically gives you the supervisory guidance on integrating the physical and transition risk into enterprise wide risk taxonomy. So this is also one of the important. In terms of measurement, they are trying to include climate risk into PD calculation, into loss given default calculation, and those adjustment it is important. Market risk stress scenario that we saw, right? Liquidity stress framework, how is the liquidity scenario for the bank in the short term if they are going to see such type of climate shock, and ultimately it is going into the governance side, management and governance, how it deals with. So this is, so climate risk is not a new risk category, but it is basically we are seeing that how we can quantify and transform that into activity, right? And I also wanted to touch upon one more angle, which is related with the risk weighted asset channel and capital erosion channel. So higher climate risk leads to higher APD. This will have higher risk weight, and as a result you will have the further higher risk weighted assets included, right? And this is where these two are important. But before that, I think we can think about one example here. So here it is. Transition shocks may downgrade carbon intensive borrowers. So this could be like when probability default increasing, your rating downgrade happens, and this will further create the risk weight. For example, if the total loan exposure is 5,000 crore, the risk weight increases from 100 to 120%, right? So if this is what is going to happen. So now you can say RWA before 5,000 and RWA after 6,000. If you are increasing the risk weight from 100 to 120, so 5,000 into 120, so it is going to be 20% increase. So 1,000 increase, so it is 5,000 plus 1 6,000. If the CAR is equivalent to 11.5%, then capital before it is going to be 575, and capital after it is going to be 115 crore, and this is where the 11.5% of this and 11.5% of this will be added here, and this is what overall looks like. The additional capital that we require is nothing but 90 plus here we have these so here you require 90 plus you require around 25 extra. So this is how it leads to 115 crore, right? So which means that the capital transition increases the so here you can think in terms of building up the scenario. So here we have the scenario given. For example, I was looking at this. So here we have the loan portfolio coming out to be suppose 5,000 crore. Your PD rises from 4% to 8%. So this is what we are seeing, right? Now your loss given default is, so this we are seeing that 100 crore, and the impact of CAR will be of course the risk weighted asset, the capital that here we have 100 upon the risk weighted asset, and this will further create the trouble. So overall what we are seeing is your denominator is also increasing because of climate risk, and your CET1 also declining because it is eaten by the common core capital. So this leads to what we are here we have the capital falls from 575 to 475 crore, and we are seeing the risk weighted asset rising from 5,000 to 6,000 crore. So overall what you see is the CAR new coming out to be less than 8%. So under Basel I it was recommended to be 8%. So here you can see that the RWA and capital erosion both are making the bank riskier, and they have less of capital adequacy standards, and this is where it is very important. I have also given you a lot of details about the rules and regulations, but before that I think it will be interesting to look at this scenario, that what was the purpose of this. So here we looked at two dimensions, the risk weighted asset channel and capital erosion channel, and this is where we are finding it easier to understand that how much it is leading to increase or decrease. So here we are saying that additional capital required is coming out to be around 115 crore, and this additional capital is because of this increase in exposure that we are seeing. And overall the summary could be that here in terms of the capital adequacy norms, when we are calculating the total capital, so we are seeing the churning in the total capital of 100 crore, and this will further deteriorate the CAR, which is coming out to be 7.9%. So with this background, I hope you are able to understand. There are different papers attached to it. So one is called the Principles for the Effective Management and Supervision. So this is the BCBS norms that here we have. So this is what here. Then here we have the Bolton and Kaspersky, very good paper. So this you can also refer, and there are others in the Hull book also. You can find risk management of financial institutions, give some idea about. Then here we have the IFRS guidelines, and this also gives the idea. NGFS, if you go on the NGFS website, you will find the details. On the RBI website, here we have the climate risk and sustainable finance, and Saunders also has the book on financial institution management. It also gives, and TCFD guidelines for 2017. This report is fully downloadable, and you can read in detail and understand. So I hope, let me summarize what we covered in the overall scenario. So in the last 3 sessions that we looked at the climate risk and the banking system, and the idea behind this is that how we can understand the climate risk and quantify that whether how much it is eating the common tier 1 capital, how much it is impacting or increasing the risk weighted asset, how much new capitals are required. Climate taxonomy we covered. We also covered the green banking. We also covered the global regulations. We also covered the BRSR. So I request all the participants, all the students to please focus on this area, because this area is expected to go to the next level, and there will be a lot of job opportunity. So you can also look at some of the courses related to climate finance, sustainability, and some of the advanced topics on the climate change and the banking, and those topics will help you guide and to make an impact in the industry. Because in India these things are evolving, so it's better to have the grip on it. And those who are doing masters, it will be very useful for the job market. You can mention on the CV also that you have the climate risk understanding, you know about ESG, so read a bit about ESG, and then you already know about banking sector indicators, in terms of systemic risk and others. So you can easily explain anyone that how it is impacting, how climate change is impacting the banking sector, and why banking sector regulation is important. And in case you find anything interested in learning, you can also write to us. We'll be happy to answer. With this, I'm stopping it here. Thank you so much. I really appreciate your attention.